First off, what's the best way to make money?
The best way to make money is have your money make money.
Okay.
So when your money makes money for you, you pay what's called capital gains taxes, and they range from 0% to 20%. That's the max.
I thought capital gains was like 50%.
No. Capital gains taxes is 0 to 20%.
Hold on. In the event that, let's say I have a house that I bought for $200,000. I sell it a year later for $400,000. You don't have to pay capital gains on that $200,000?
You have to pay capital gains taxes on that $200,000, but the highest capital gain tax rate is 20%.
Really?
Versus your personal highest tax rate is 37%.
Whoa. Wow.
People end up overpaying taxes, bro, simply because they don't know the rules of the game. And it pains me. If I can give your audience anything, the biggest thing that everybody needs to understand is that the tax code is not here to make you pay a lot of money in taxes. The tax code is an incentive system that the IRS created because they wanted us to do things.
Right.
If you do what they want us to do, they're okay with us not paying taxes. You have two choices. You can do the things that they want you to do, like start businesses, invest in real estate, and then you get to keep your money. Or you can not do it and they'll take your money. The choice is yours.
In what cases do people go to jail?
People go to jail.
Welcome to another edition of the Social Brew Podcast, man. We find amazing individuals who are successful, accomplished, that have receipts. We got to add that on there. You have receipts, right?
Yes, I have receipts. You know I got receipts, man.
I know you do, but I'm saying the people, they may or may not know. I don't know.
Gotcha.
So we have Carter Cofield at the right time right now because taxes, that's a conversation that I honestly don't like having. It's a nasty. You're up to date on your taxes?
Yes, absolutely. It's not a bad conversation, bro. It's
a couple dollars.
It's
this is a safe space? Hold on, Di, you all good? You up to date?
I'm up to date.
I helped them save a couple $100,000.
You owe something? You owe a little something. You owe nothing at all?
Because the card I don't.
All right, well, can you do something about what I owe already?
I could do something about it, making sure you don't owe this year.
Oh. Hey, man. These choices are vicious. But it's and I think the challenge sometimes is finding the right team of people who can do it. That's like the major challenge. Because I've been going from like team to team, and then this person, they just don't do it right. And then I got to transfer all this stuff. And I did like this whole restructuring of like S Corps and C Corps within S Corps. That's part. Yeah. I got a lot going on.
Well, the more money you make, the more complex strategies you got to implement.
Yeah.
Right. And so it's a good problem to have, but it's like, if the more money you make, the more complicated your tax situation is going to be. And sometimes real talk, sometimes the juice of the tax strategy is not worth the squeeze. So people have to understand, like, not only is the tax strategy good, but more importantly, is this tax strategy good for you?
Yeah.
Right?
That makes sense.
Because you can buy a jet for $150 million like Grant Cardone did, wipe out your entire tax bill, but like now you have the jet. Now you got to like know what to do with it. So like I'll be the first to say that I can help people save hundreds of thousands, millions of dollars in taxes, but at the same time, I want to ask you the honest question that if I implement the strategy, is it going to be worth it for you?
Right. Okay. The whole trust conversation. I want to have this conversation with you. What are your thoughts about a trust?
Everybody should have a trust. Every single person.
All right. So, and it's the advice that I'm hearing, right? But also, I was talking to another team of people. They're like, yo, people think you just set up a trust and it's cool, but it takes financial planning, like really seeing how the money goes, and people set up a trust and don't know how to maintenance it. And that's from what I'm hearing. Yeah,
so you want to set up a trust. There are two types of trust. There's a revocable trust and an irrevocable trust. Most people should have a revocable trust, which means that once you set up the trust, if you want to change it, if you want to revoke it, if you want to throw it away, you can, right? It gives you flexibility to be able to do it. An irrevocable trust, meaning once you put that asset in that irrevocable trust, you don't own that asset anymore. The trust owns the asset, and the beneficiary of the trust is going to get the asset. So what's important is that everybody should have a trust, a revocable trust, and here's why. If you don't have a revocable trust and something was to happen to you, you have this business, you have this amazing studio, you have this money in this savings account, you have this money in this business account, all that stuff will go to probate, meaning it will go to a courtroom, and then your kids, your wife, your cousins that you haven't heard from in years, they all gonna be fighting over the estate of Shan's, right? So if you don't have a trust in place, you can not only lose a lot of money in probate court, but then your assets don't go to the right people. We saw that happen with.
But what about having a will? That does the same thing, no?
A will does not do the same thing as a trust.
What you just said, though.
Right. A will is like a statement of like what you want your assets, like what you want to happen with your assets. A trust, but if you have a will, you can still go to probate court because they can argue over the will. But if you have a trust in place, the trust is going to tell who the beneficiary of each asset is. And with the trust, you can set it up where, let's say you don't want your kids to get all the money right now. You can say at the age of 18, then my kids get this amount of money. And then every year they get that type of money, that amount. So it gives you more control over the money. Because here's the thing that happens with most wealthy people like yourself. You want to pass down these assets, but you don't want one generation to ruin all the good that you did. Yeah. So you can actually set up a trust where you pass assets, half your assets to your daughters or your sons, and then the other half to their kids, so that you keep the generational wealth train going.
Got it. Okay. You didn't owe nothing from last year?
I owe taxes last year.
I was about to say.
Yeah. Because
but also I gotta like talk about this too, because and again, maybe it's right or wrong. This is just what I'm getting information as I'm learning this stuff. That people are trying to get trust as a way to not pay taxes, and that's illegal. The irrevocable trust is a strategy that you can leverage to like lower your tax bill, but the repercussions of that might be worse than the tax bill because now you no longer own the assets. There are way easier strategies to implement than trying to leverage an irrevocable trust for tax saving strategies. Because once you pass the asset down to the irrevocable trust, you now no longer own the asset. Right, so you can't sell it. You can't, like, the trust owns it, and then the beneficiary gets in the grantor of the trust get to dictate. So you lose control and ownership of the asset. But if you want to save on taxes, I wouldn't leverage a trust to do that. Trust is to make sure your assets go down to your kids the right way. If you want to save on taxes, implement tax saving strategies outside of irrevocable trust. Like that's like 10 million plus in my opinion, when you need to like focus on irrevocable trust. I see what you're saying. So people shouldn't look at a trust as a way to not pay taxes, correct?
No, they shouldn't.
Okay, but there are a lot of people that look at it that way, right?
And they're significantly misled.
Gotcha. Okay. So let's talk about these tax savings strategies. First off, what's the best way to make money?
The best way to make money is have your money make money.
Okay.
So when your money makes money for you, you pay what's called capital gains taxes, and they range from 0% to 20%. That's the max.
I thought capital gains was like 50%.
No. Capital gains taxes is 0 to 20%.
Hold on. In the event that, let's say I have a house that I bought for $200,000. I sell it a year later for $400,000. You don't have to pay capital gains on that $200,000?
You have to pay capital gains taxes on that $200,000, but the highest capital gain tax rate is 20%.
Really?
Versus your personal highest tax rate is 37%.
I thought, okay, let me just do some. This is good, Carter. Yeah. I'm enjoying this.
And one thing that everybody should understand is that if you buy a home, if you hold it for 2 years and you sell it, you don't have to pay capital gains taxes on the sale of that home. So I would tell you, like, Chance, hold on, wait one more year. It might be worth $500,000. And now you eliminate taxes on that whole amount because you get what's called a homestead exemption. So people end up overpaying taxes, bro, simply because they don't know the rules of the game. And it pains me because if they had the right person to just ask the strategy or get the rules of the game from, they would just save a whole bunch of money. Like the tax code, if I can give your audience anything, the biggest thing that everybody needs to understand is that the tax code is not here to make you pay a lot of money in taxes. The tax code is an incentive system that the IRS created because they wanted us to do things.
Right.
If we do what they want us to do, they're okay with us not paying taxes. If we don't do the things they want us to do, they're going to take your money and do the things that they want to do anyway. So you have two choices. You can do the things that they want you to do, like start businesses, invest in real estate, and then you get to keep your money. Or you can not do it and they'll take your money. Choice is yours.
Okay. So let's talk about digital money for a second.
Okay, let's talk about digital money.
Because it doesn't take a lot of money to make it sometimes.
Yep.
So I'm having this conversation with Terica, and she's new to this digital space.
Yeah, I was talking to her about it.
She was like,
she's like, it's crazy.
Oh, bro.
Yeah, she's so flabbergasted.
She's
I was
like,
happening.
yo, real estate, I understand that. She said, all the stuff that y'all doing, like, I just make money. I ain't got to worry about those. But like now that I'm online, like I'm making this money, and it's different rules to the game. So talk to me about the digital income versus somebody who is investing in real estate and they make money that way.
Yeah. So the great thing about having a digital business is you can make a lot of money in a short amount of time.
Yes.
The bad thing about having a digital business is that you make a lot of money with not a lot of expenses. So your profit margins are huge. The average digital business has 60 to 70% profit margins, which means that if you make $1 million in your digital business, your profit is going to be $700,000. So now your job is to find out, how can I strategically get this $700,000 off of my books so I don't have to pay taxes on it? And there are two ways that you can get that $700,000 off your books. You can spend the money on tax deductible expenses, which will wipe out some of that income, or you can invest the money into tax advantage assets, which will also help you wipe out the money. Now, the level number one is spending money on tax deductible items. That's cool. And we've talked about that on our previous episodes, and we can talk about some strategies there if you want. But the next level is, how can I invest money and get tax deductions?
Let's act like they didn't see the first one.
Okay. So if y'all haven't, episode 203, it was a fire episode. Yeah. So here's the first level. The first level is, the IRS says if you have a business, any expense that is ordinary and necessary for you to operate your business is a tax deduction. So you have a podcast. These mics are ordinary and necessary. Yep. So these mics, you pay for these mics. These are tax deductible. The camera is tax deductible. All these expenses related to your business, you get to write off. Now, the dope thing about that is, when you first start a business, a lot of your personal expenses that you were paying for anyway immediately become tax deductible business expenses. For example, your cell phone. If you work a W-2 job, you can use your cell phone at your job all the time, but you don't get a tax deduction. The moment you start the business and use your cell phone to call your customers, guess what? Your cell phone is now ordinary and necessary to operate that business. So now you get to write off a portion of your cell phone bill. So now 50% of your cell phone, 50% of this iPhone, and 50% of the cell phone bill is now tax deductible in your business. So you can start looking around your house like, how can I, wait a second. So you mean to tell me if I use this office that I have in my home for my business, I get to write off a portion of my rent? Absolutely. So now then you get to start thinking strategically about, how can I turn these things I'm already paying for into things that my business needs to use? My business pays for it. The IRS gives me tax deductions. Tax deductions turn into tax savings. That makes sense.
Okay. So when I go to Turkey to get my hairline restored, that's not,
talk about it.
That's not ordinary and necessary to my business. Kinda it is, because if I look good, I'll make more.
There you go.
So that seems illegal. You know what I mean? It seems.
So I wouldn't leverage because the IRS is really strict about like appearance things. Like actors can't say that just because I'm getting my barber comes to me, I cut my hair, that I can write it off in my acting business. The IRS is really serious about appearance-based stuff. But I love your creativity, because when the IRS says any expense that's ordinary and necessary for you to operate your business is tax deductible, the IRS does not get to decide whether something is ordinary or necessary. We get to decide whether something is ordinary or necessary. So for example, there was this a client I work with in California, a real estate agent, making a lot of money in their real estate business. They had a yacht that they would take out, and they would show the clients the real estate property from the water because it's a better view.
Extremely necessary.
And they would close higher percentage in sales because of the waterfront view. So they were actually able to write off their boat expenses because it was ordinary and necessary for them to operate their business. They had a log on the boat showing all the clients they brought on the boat. So usually people like a boat is not ordinary necessarily to operate your business, but in this particular case, it is because it's helping the business owner make money. So the question is, how creative can you be in your business to turn these expenses into tax deductions?
This hairline ain't gonna do it, bro. Unless I'm trying to be like a hairline model.
Yeah. I mean,
unless I have aspirations to be on the barbershop poster.
Yeah.
But if I do, if my goal is to, like, if I start taking pictures and I'm submitting that to the barbershop posters.
Yeah. And you get the job, absolutely.
What if I don't get the job and it's just an expense?
If you don't, I mean, it's in the pursuit of money. So a BBL for strippers. Yes, because that is ordinary. That is necessary. So this is what happened. It was actually a really, really funny article that came out. This OnlyFans model, before she had her breast implant, she was only doing like $5,000 a month on her OnlyFans. Then she got breast implants, and then she was doing $30,000 a month on her OnlyFans. And her accountant allowed the surgery to be tax deductible. Now, she hasn't been audited, so we don't know. And again, that's like, so the tax law changes when we have more cases. So this was the first case. So we don't know, if it's going to pass in court. But but in my opinion, I'm like, if it's documented that she's able to make more money after this surgery, like, who are we to say that wasn't ordinary and necessary?
Got it.
To operate her business.
Got it.
So I don't know, man. That was an interesting case though.
So what if we decide, okay, this is ordinary and necessary, and we file our taxes? Nobody knows until you get audited. And if you are getting audited, it's not like they take you to jail, right? You gotta pay that now.
Yeah, if you have a case and you're trying to fight the case and you lose the case, you just have to like pay that money that you would have paid if that expense wasn't deductible.
Oh, okay.
Yeah,
that makes sense.
Yeah, so it's like, again, unless you're being erroneous and you're lying and it's fraud. But I tell people all the time, an audit is nothing to be scared about. An audit is just like going to the dentist. If you haven't been brushing your teeth, if you haven't been flossing, you probably are going to be nervous going to the dentist. Yeah. But if your paperwork is in order, if you're taking care of business, if you have your receipts, then an audit is like a checkup and everything might come out good.
For sure. Yeah, I think the good news is over the last couple of years, I have been good at tracking all of our stuff. And every month or so, I get this Ask Accountant paperwork from my accountants to say, okay, what are these? And we fill them out and, kind of identify them. So that's really good. But we need to figure out how to not pay so much.
This studio should have saved you a lot of money in taxes.
Yes, because we did the
cost seg?
We did the cost segregation.
Okay.
Yeah.
Okay.
So,
Can I explain that? Should I explain that?
Yes, please.
Okay. Yo, what's up, Social Proof family? So I know you're watching a dope episode and we'll get right back into it. But in the next 2 minutes, I want to teach you the number one mistake that's probably costing you over $10,000 in taxes. And then I'm going to teach you how to fix it. And at the end, I have a free gift for you. So let's get right into it. So the number one mistake that most people make, especially business owners, is they have the wrong entity set up. Like, guys, LLCs do not help you save on taxes. So let me give you what I call my entity timeline so you can know when to have the best entity for you and how to save the most money on taxes, okay? So step one, before you have the business, I do want you to set up your LLC, but not for tax savings, for asset protection. So you can go to a free website like llcuniversity.com. It's gonna teach you how to set up your LLC 100% free. Now, you're gonna stay at LLC until your business makes over $40,000 in net income for the year. Once your business makes over $40,000 net income for the year, it's time for you to upgrade that LLC to a S corporation. S corporations actually help you save on taxes. How much so? Well, let's put it like this. If you had an LLC making $100,000 and I had an S corp making $100,000, you would pay over $10,000 more in taxes than I would because I have the proper entity. So once you make over $40,000 in net income, it's time for you to upgrade that LLC to an S corp, and then you're gonna stay at S corp until you start making over $3 million in profit, and then it might make sense to upgrade to a C corp. But that's it, guys. LLC where you start the business, S corp where you make it over 40K, C corp after $3 million in profit. If you want a free guide on this, I'm going to give you my tax-free ebook, 100% free, and I'm going to be teaching a class breaking the ebook down for you. All this 100% free, but it's only for my social proof family. So all you have to do is text the word proof to 312-847-2309. That's proof to 312-847-2309. Now let's get back to the episode. So, like I said, level one is how do I buy things that my business needs to save on taxes, right? That's what the first thing I think people should start doing when they want to save taxes. The second level is how can I invest money, make more money, and save on taxes at the same time. So this is what I call the self-rental strategy. So if I was to buy a piece of real estate like this content studio, so let's say I'm a digital entrepreneur, I got all this, I made $1 million and I have $700,000 of income that I got to like find a way to wipe out. Since I'm a content creator in my digital business, I can buy a studio like this and that I'm going to shoot content in. So let's say the studio cost $1 million. I put $200,000 as a down payment. So I invested $200,000 for this $1 million studio. I can do, the IRS will give me depreciation on this building, which basically means that because this content studio is gonna it's gonna have wear and tear, that they're gonna give me a depreciation deduction for this content studio. Normally, the way you calculate depreciation on a unit like this is you take $1 million is how much it costs, and you divide it by 39 years, which would be, let me see, 1 million divided by 39. Divided by 39. So you would get a $25,000 depreciation deduction, which means that you get a $25,000 write-off per year for this building.
Not a lot of money.
That's not a lot of money, right? So a way that you can speed that up is doing what's called a cost segregation study, which basically is a fancy word for let's speed this process up. Yeah. So instead of getting only $25,000 a year, you will get to write off 30 to 40% of the value of the building the year that you purchase it. So if it was $1 million content studio, you would get a $400,000 tax deduction.
Oh, okay.
For that, so you exchange.
If I'm being honest,
yeah,
I know I had to do the cost seg because one, it cost me like $5,000-$6,000 to do cost seg.
Yeah, and that's also tax deductible too. The study.
I honestly didn't know how to calculate it because Terica's walking me through all this stuff. She's like, you do this and you do that, you save money. I'm like, I just know I'm going to save more than the $5,000. So let's just do the cost seg, right?
Yeah.
So let me tell you my scenario. But I couldn't, according to my last tax people, I couldn't write off the expenses of the building until I opened it. That's correct, right? Until I started operating.
Yes.
Okay, so we
unless
we opened, okay.
Well, yeah, I'll let you finish.
We opened October. I bought it in 2020. Mm-hmm. We opened in October 2022. So, and most of it was 2023 in the business. Mm-hmm. So all the money that I put into the business in 2022, that's the year it all gets written off?
It has to be, so you have to wait until the business had made some money. So let's say you had all these expenses in 2022, but the business didn't make money in 2022. Mm-hmm. You can't write off expenses in the business that didn't make money.
Oh, wow.
But what you could have did, you could have rented the building to yourself.
Yes.
And you could have been the first person to make money.
Yeah.
And then that would have unlocked all the deductions in 2022.
But because I don't think I did, in 2023, it'll unlock all those deductions.
Exactly.
Okay. Oh,
yeah.
Yo, I was looking at like some of the, I was like, we was going through, what we made last year, and I said, ooh-wee.
Yeah. Yeah.
So tax going to hit, but let me give you this scenario. So I did a cost seg, and we're good on that. We did that last year. So the building, I'll just give you the real numbers. The building I bought for $495,000. Okay. I did an owner financing deal, meaning the owner of the building financed it.
Okay.
So I'm paying the owner the interest. All that interest I can write off, right? Because it was an interest-only loan.
Yes, all the interest related to the property all business loan interest is tax deductible in all cases.
Okay, cool. So all the interest that I was paying, I get that. So come 2022, I want to say it was 22. I don't know if it was last year. It might have been 22. So I paid the whole thing off. So I paid off I gave him the $500,000. So right now I own it free and clear. And I put in like $200 and something thousand. So I'm about $750,000 in. Am I able to take that whole $750,000 off?
Nope.
No?
You can't write off investments in full like that. So
only the improvement.
No, improvements are capitalized as well. So when you improve the value of something, the IRS is saying that, hey, you're making this thing more valuable. So it's not like you're spending money, you're AKA investing money. So you're going to have to capitalize the cost of the improvements, which means you have to take a little bit by time. And usually it's over 15 years. So that was 200.
So the 250 I put in, I have to write that off over how long? 15
years usually, yeah. They're not going to give you that all in one time. But the beautiful thing is you do get to depreciate the property over time. So like that $500,000 building you bought, if you do a cost save on that building, you should be able to get 30%.
That's what I'm talking about this one.
Okay. You should be able to get 30 to 40% of the deduction. Here's the beautiful thing. You're investing money. So like, let's say this building might be worth, let's say you put 700,000 in, but you it's worth $1 million later. You got $300,000 in equity.
Yeah.
You can borrow against the equity of the building. So now you can get $300,000 and loans are not taxable. So now you just got $300,000 of tax-free money that you can now use to buy another property. So let me break this concept down. So this concept is called earn in pocket, lose on paper. So the beautiful thing about real estate is that you can literally earn money and not pay taxes on the money that you earn. So if I own a property in Chicago, it's $500,000 and it makes me $1,500 a month, which is $18,000 a year. So $18,000 a year in profit after expenses hits my bank account. Most people would assume I have to pay taxes on that money. But because of my depreciation deduction, I don't have to pay taxes on that money because the depreciation for residential properties is take the amount you purchased divided by 27 and a half years. So if you do 500,000 divided by 27 and a half, you're going to get $18,181. So my depreciation deduction is $18,181. My profit is $18,000. So my depreciation deduction alone,
you lost money,
wipes out all my profit, and I lost $181 on my tax return. So I have $18,000 in the bank, but I have $181 loss on my tax return. And if I do 3 properties, same thing. Now I have $54,000 in my bank, and I have a $500 loss on my tax return because each of those properties gets depreciation. So I can make $54,000 through real estate and not pay tax, like $54,000 passively in real estate and not pay any taxes on that $54,000.
That's why real estate is such a valuable investment vehicle.
Exactly. Because now, let's say I paid $500,000 for that property, but now it's worth $1.2 million. I can do a cash out refinance or a home equity line of credit, and I can take $700,000 out in equity tax free. I can use that $700,000 to buy a $3 million property, and I can keep rinsing and repeating and start and like borrowing money tax free and making cash flow tax free from the assets. That's why Terica is a beast at what she does.
Got it. You actually answered both questions, the difference between making digital money and real estate. That's why it's so different.
Yeah, exactly.
Got it. And I was under the impression, and I had it totally wrong, that if I take $100,000 and I buy a $100,000 property, then
you get $100,000 write-off?
Yeah, but not the case.
It's not the case. But the good news is you do get cash flow and you do get the depreciation, and that property's going to go up in value, and you get to borrow against the equity and use that equity to buy more property.
In what cases do people go to jail?
People go to jail when either they have a really bad CPA or they're doing fraudulent things, or they just don't pay their tax bill. So here's the problem. Most people don't file their taxes because they're scared of what the bill is going to be. The failure to not file is worse than the penalty for not paying. Like the penalty if you don't file is 5% per month. So if you owe $100,000, you have a $5,000 per month penalty for not filing.
Whoa. Wow.
The failure for not paying, if you file, the failure for not paying, I think is 0.5%. So it's almost 10 times less. Just file the return and do a payment plan. Don't not file.
Yeah.
Because the IRS is just like an ex-girlfriend. They hate being left in the dark. You know what I'm saying? So like, don't do that. So yeah.
Wow. Incredible.
Yeah.
This is incredible.
Yeah.
So okay. What percentage of your income do you pay in taxes? Around about?
I'm probably in the pan last year. I think probably around 10%.
10%.
Yeah.
So if you make $1 million, you pay 100,000.
Yeah, but it's only at 10% because of what my income is.
Yeah.
Right. The more money you make, and I can implement strategies to get me down to zero, but is the strategy worth it? Like I can go move to Puerto Rico and have a cheaper corporate tax rate, but do I want to have to spend 180 days in Puerto Rico? Probably not. Right.
I mean, it's nice.
I mean, it's nice, but like,
hold on, bro. No, yes. To spend 180 days in Puerto Rico, it's almost like someone paying you $100,000, or let's say, and you make more than that, but a few $100,000 to live in Puerto Rico?
yeah, I mean, like with tax strategy, you just have to ask yourself the question, like, is this a strategy that's going to be worth it for?
Because if you're in the States, you'll make more money.
Yeah. Now you're missing out on podcast opportunities, you're missing out on speaking engagement because you have to have this 180 days in Puerto Rico.
Is that why you moved to where you moved at one time?
No, I moved out there because I like living out there.
Where was you at?
Medellin.
The Medellin joints.
Yeah, the Medellin joints.
That's why. He won't take 100,000 on taxes, but he will move for sure.
It's about what you want. It's about what you want. But no, so here's another thing I think everybody needs to understand. So the two best investments that you can make to lower your taxes, in my opinion, is real estate and then yourself. Because society taught, and I want to say this, I want to preface by saying this, I have 5 years of college education. My college education was $125,000.
Right. You still owe it?
No, I had grants, so I was good.
Oh,
I got all paid for. But
I still owe. I still owe. Bro,
Like
I'm not paying that shit, bro. It's like the principal, and it's only like, I think I may owe like 16, 17,000.
Yeah.
And I'm holding off for Joe Biden.
Yeah. I was about to say, you just paid $500,000 in cash for the property, but that's $16,000.
Oh, no, it's the principal, bro. It's the principal. Because like every year we hear that Joe is going to make this thing happen. It's going to wipe out all the, and I would be sick.
Yeah.
If I pay this money.
Because they ain't going to give it back. I tell you what, they ain't going to do. They ain't going to give it back to people who pay.
Y'all going to get this $200 a month for the rest of my life.
So here's the thing. Society convinced us that we need to go to college and pay $100,000 for education, first of all, to go learn from somebody who's probably not even doing the things that they're teaching us to do, and who for sure ain't making the money we want to make. So we're going to go to college, pay these people $100,000. And on top of that, you can't write that $100,000 off for education. No, college tuition is, a portion is deductible, but once you make over $65,000, you phase out. So that means you make too much money to get to deduct college, which is crazy. And then on the student loan interest, the max you can write off in student loan interest, I think, is $1,500 a year.
Wow.
So they cap the income, and then they cap the student loan interest. So I'm paying $100,000 for all this education. I can't write it off on my taxes. But you mean I can go pay a multi-millionaire like Alex Hormozy to teach me about marketing. I can go pay a millionaire like Shands to teach me about podcasting. And I can go pay somebody who's doing the work and who has the receipts and who's earning the money I want to earn. Any dollar that I pay you for coaching, for your courses, for all that, that is 100% tax deductible to me. And if I use business credit to pay for your program, not only do I get to write off all the interest on that loan I took for your education, I also get to write off the cost of the education. So I get two write-offs. So I get to write off 100% of the interest, and I get to write off 100% of the cost of the education. But people are scared to pay for education.
Wow. There's a lot of things you can do with $500. I mean, you can have a night out with your significant other. You could buy some really expensive shoes. Well, really nice shoes are about double $500. You could buy a course where you can learn something for $500. But I have something better for you to do with the $500. I want to meet with you every single morning for the rest of your life. Well, maybe not the rest of your life, but every morning, Monday through Friday, for the rest of the year. I have information and game that have allowed me to build a successful business, a successful community, and a successful life all the way around. But I want to share that with you. But the only way we can accomplish this is not me selling you a course, not me giving you a one-on-one consultation, because even with that, you'll get the information, but you'll need more. I want to meet with you every single morning. Now, would I meet with someone every morning for $500 for a year? And the answer is yes. Actually, we've been doing this thing since 2017. We have what's called the morning meetup. Every single month we have a theme, whether it's social media, whether it's motivation, whether it's strategy, whatever it is, we have a theme for the month, and every morning in that month, we have a conversation around that topic. And I am giving a wealth of knowledge, not only myself, but a lot of friends, a lot of people that you see on this podcast, they join every single week. So you need a community of people that you can grow with, and you need a coach. I'm your coach. The Morning Meetup is your community. Go to themorningmeetup.com. It's $499, and I will meet you every single morning for an entire year. Give it a shot.
Because we've been taught to pay for the wrong education.
Right. Dang. This is good, man. This is good. I didn't know. You can't write off the money that it's a scam, bro.
It's a scam. It's like you write off a little bit of college tuition, but once you start making over any type of real money, they say, oh, you make too much money to get this tax deduction.
Let me ask you this too. It's almost like side note stuff. You are teaching financial literacy. Now, I don't claim to teach financial literacy because I don't. I teach entrepreneurship, right?
You're financially literate, though.
I'm financially literate.
Yeah.
To a degree. Yeah. You know what I mean? Like, there's always levels. The stuff you're talking about, I have no idea. I talked to Terica, I have no idea what she's talking about. But I'm learning. I'm learning, right? Yeah. But the financial literacy space, even more than me, is constantly under attack. Because you're going to say something about a strategy that allows you to lower your tax burden. And there's somebody out there that says, well, that's wrong. How does that make you feel being in this space?
Well, I learned that people typically fear what they don't understand. So that means that if somebody doesn't understand something, it makes them insecure, and then they will attack the person who said it because they don't fully understand it. Yeah. And I try to always preface, I said it on this episode a few times, every strategy is not for everybody. So just because I say a strategy on a show, you can't take that as face value that it's for you. Yeah. Right. So I think that for me, I don't take it personally, because I know I study everything that I talk about. And the clients that I do work with, I make sure that any strategy I'm giving them is directly beneficial for their situation. Gotcha. You know, so I think the financial literacy is under attack because we went from having nobody teach it to having everybody and their mama and their cousin and their niece teach it as well. And I think we'll get to a common ground soon where the people who shouldn't be teaching will either get sued, or they will get sued, or they'll get filtered out, and there will be a space left of people who know what they are teaching. Because like, I'm a licensed professional. Like, I have had my CPA license for over 10 years. I'm not going to lose my license for you. I'm not going to lose my license for the internet. I'm not losing my license for nobody. So I do my best to give education and give advice, but also give realistic examples that people can implement in their lives as well. Right.
But if you ask like 5 different CPAs about a financial strategy, you're going to get 5 different answers, right?
Yes. And some people are just lazy. So just because they don't understand something, they assume that it's wrong. Like, one of the biggest misconceptions that entrepreneurs I see when it comes to like my space is that a CPA would tell them, you have to own your car and your business to write it off. That is false. The IRS does not care who owns the vehicle in order to write it off in your business. All the IRS cares about is, do you plan on using this vehicle 50% for your business at least? So David Shands owns the Cadillac Escalade. But David Shands uses the Cadillac Escalade 80% of the time for his business, and he uses it 20% of the time for personal. Even if the car is in your name, you still get to write off 80% of the expenses associated with the vehicle because you use it 80% for your business.
Got it. Yo, this was one of the issues that I ran into because I was putting everything in my business name.
Yeah.
Like, and I have a bunch of businesses. So I, like the van out there, wrapped it, put it in my business name. A vehicle, like I got my Tesla, that's in another business name. And the challenge I was having was I don't have many things in my personal name, so it was affecting my credit.
Yeah. And I still like you having the cars in your business name because the cars are business assets and it builds your business credit. But you still need to have something in your personal name to build your personal credit.
For sure.
You know what I'm saying? So there's a gift and a curse to everything, but there are a lot of misconceptions that people's previous accountant has came to them with and they came to me with, and it's just been a complete lie.
Got you.
I think I know two more off the top of my head if you want me to go into those.
Yes, please.
Yeah. So a lot of lazy CPAs tell their clients that if you take your home office deduction, you're going to get audited and you're going to be at risk. And that is false. And the reason that they think that's true, because back in the day, 1995, somebody having a home business was unheard of or extremely unlikely. But in 2020 and beyond, it's commonplace. So I have a lot of people missing out on being able to deduct their rent or being able to deduct their mortgage because their previous CPA told them don't do it, they're going to get audited. But their CPA is living in the 80s, in the 90s, when they need to be living in the 2020s.
Got it.
So it's like little things like that I see people just miss out on massive tax savings because their CPA was too lazy to do relevant research.
Yeah, got you. What do you do with your money?
I invest it.
All of it?
I invest. So I would say 50% of my money gets invested back into my business, and then like the other 30 to 40% gets invested in assets, and I think I'll live off 10% of my money.
What are some of, when you say putting it back into your business, what do you mean? Give me examples.
Marketing, a lot of money. A lot of money goes back into marketing because if they can't know you, they can't flow you. So a lot of my money goes back into marketing and team. I think my team probably costs $50,000 to $60,000 a month at this point because I'm trying to grow an empire. I'm not trying to grow a little business. So, and because I'm employing these people and giving these people benefits, the IRS gives you massive tax savings, massive tax credits for employing these people.
Yeah, you know what though? When you start running that payroll, you got to pay payroll taxes. You got to pay taxes to pay people, which is crazy to me.
Which is crazy. So, and that's why I say like people like think that like not paying income tax is a bad thing. No, like you should want to pay as minimum income taxes as possible because you pay federal tax, you pay state tax, you pay payroll tax, you pay sales tax, you pay capital gains tax. I'm trying to get my income tax as low as possible because I have to pay all these other taxes. So I'm doing everything in my physical nature to minimize my tax bill as low as I possibly can. And that's why I reinvest so much money back into my business.
Do you still do taxes?
I don't prepare taxes. I still review tax plans because a tax plan is equally as important to the tax prep. Because the problem is most people get mad at their tax preparer for not being a tax strategist when you didn't hire them to be a tax strategist.
So you're a tax strategist.
I'm a tax strategist.
So you still do tax strategy sessions with people?
Yes. Our clients who have the most complicated situations, I still oversee and implement the tax plans.
How much you charge? Around about?
It's 5 figures minimum.
Word?
Yeah. Because I know how much I can save you. So like if I charge somebody $20,000, it's because I can save them 100.
That makes sense.
So not paying me $20,000 is costing you 80.
Yeah, that's a fact.
So it's like, yo, you can pay me and my fee is tax deductible as well, or you can pay the 100. Like you're gonna pay somebody, you might as well pay somebody that gives you a return on your investment.
Can I have an affiliate if somebody book you off of here?
You can have an affiliate for what we talk about after this.
That's cool.
Yeah.
I'm excited about that.
Yeah, I mean
okay. You put the money into your business, marketing, things of that nature, education.
Right? Oh yeah, probably spend a lot of money.
But the investment side,
yes.
Give me some examples of what you invest in.
So I have a solo 401k for my business, which allows me to put away $69,000 and get a $69,000 tax deduction for doing so.
You put away $69,000 and you get to deduct that whole $69,000 as if it's a business expense, like you bought some cameras or something.
Exactly.
Where does that $69,000 go?
I invested in stocks. So the $69,000 goes into my solo 401k account.
What is a solo 401k?
A solo 401k is an investment account that a business owner can set up if they are if they're the only full-time employee of their business, or if they like have another strategy where they can. So you either have to be the only employee of your business, you can employ your spouse, or you have to be the only full-time employee of your business.
Got it. And
I have my business structure where I'm the only full-time employee in one of my businesses. So that business gets to have a solo 401k. So I get to put away $69,000 into that account, and I get a $69,000 tax deduction. And if I ever need money, I can borrow from that investment account to fund other things.
Gotcha. Okay. So what do you do with the other $8 million?
Counting so right now I've been heavily invested in real estate. So I just bought a $1.2 million property in Texas last year. And because of the cost seg, I'm probably going to get a $370,000 tax deduction for that property.
You bought a $1.2 million property.
Put $200,000 down.
Put $200,000 down.
Yeah. And
then you'll get $300,000 back?
No, I'll get $360,000 tax deduction.
$360,000 tax deduction because you bought a $1.2 million. I don't understand.
Okay. So let me do the numbers.
Please.
$1.2 million property. I put $200,000 down. The rest is financed, right? The same strategy I told you before. I'm doing a cost seg on that property. So I'm getting to write off a little over 30% of the value of the property. So if we do 1.2 million.
I see.
Yep. Times 0.3.
You'll get that back.
That's $360,000
that you purchased.
$360,000 write-off. Yep. So I exchanged $200,000 to get a $360,000 tax deduction. Not to mention the property is probably going to make me, because it's a short-term rental, it's probably going to make me anywhere from $15,000 to $20,000 a month. Maybe 15. Yeah.
That makes sense. You got to pay money. You got to pay taxes on that though.
No, because the depreciation is still going to wipe that income out. So like the depreciation I'm going to make on the property the next year should wipe out majority of that income.
The cost segregation and depreciation are two different taxes.
Cost segregation is like a lot. You get a lot of your depreciation in the first year.
Explain the cost segregation.
Okay.
I did it. I just don't understand it.
Okay. So here's why it works.
And I'm going to pull it up too. So maybe you can read my cost seg and see what I'm supposed to get.
Yeah. So when you don't do a cost segregation, the IRS is putting all the fixtures and the walls and the ceilings under one category. Okay. When you do a cost segregation study, it strips out the different aspects of the property. So they're like, well, this ceiling should not have a 27 and a half year useful life. It should have a 10-year useful life. Okay. So it's gonna shorten the time to take the deduction. They look at the stove and the desk and say, well, that desk should have a 5-year life, not a 27 and a half year life. So it separates out the different components of the property to fast forward the depreciation on the property.
Okay. So, do you understand this?
You found the study? You found the study?
Here's some numbers. Show me what I'm looking at.
Okay. So let me see. This is
it's like 5 different emails.
So you see where it says 5-year property, $50,000?
Yeah.
So $50,000 worth of the things in this building should be depreciated over 5 years instead of the 27 and a half years. So if something is depreciated over 5 years, you're going to get more in the first 5 years than you would over 27 and a half. That makes sense?
Only $50,000?
Only $50,000 worth of stuff was, yeah. So, and then $160,000 has a 15-year useful life versus a 39-year useful life. So basically, you get to depreciate it 20 years faster because it's 15 versus 39.
Got
So then the rest is 39 and a half. So you essentially took $210,000 that would have been, if you had to wait to depreciate over 39 years, you got to depreciate over 5 and 15. So it accelerates the rate in which you get to depreciate.
What about
these
this
things.
year, bro? Like, just give me like, the 5 and 15 don't excite me. What am I saving right now?
Okay. So you're saving right now, it looks like 218. I think you can say you get a $218,000 tax deduction this year, which in your tax bracket is going to save you $74,000 in taxes.
200. Why don't I get the whole 200?
Because the $218,000 is the tax deduction, but then you have to take the tax deduction times your tax rate to get your actual tax savings.
No, why? Hold on. If $200,000 is tax deduction, why don't I deduct $200,000?
Okay, let's talk about that. So most people don't understand the difference between a tax deduction and a tax credit.
Okay.
If I get $100,000 tax deduction and I'm in the 37% tax bracket, I have to take that $100,000 and multiply it by my tax bracket to see my actual tax savings.
Okay.
So if I had $100,000 tax deduction and I'm in a 37% tax bracket, I've actually saved $37,000. Not $100,000. The $100,000 was the deduction.
Okay.
And do you multiply your deduction times your tax rate to get your actual tax savings amount?
I see. If I make $1 million, just because I spent $100,000 on cameras, it doesn't take away $100,000 that I owe. It just takes $100,000 off of the $1 million, meaning I'm taxed on $900,000 now.
Exactly. So when you look at your actual tax savings, it's whatever your tax deduction is times your tax rate. So if you're in 37% tax bracket, you actually saving $37,000. So for this,
are you on 37% too?
Yeah, that's the highest tax
do
bracket.
Nothing funny.
Well, that's like the tax bracket. That's the tax bracket I'm supposed to be in, but I'm not in that.
That's what I'm asking.
Okay, no.
You finessed.
I took advantage of the tax code.
So what's your tax bracket? Oh, that's the 10%.
10%. Yeah.
All right. So okay.
Yeah. Because I leverage strategies to get my tax rate lower. So I think a strategy that maybe is helpful for your audience. Trying to think. Yeah. So here a strategy that anybody can take advantage of to get some tax-free income for themselves. I'm talking tax-free rental income, and they don't have to rent out their property to anybody else.
Okay.
Ready?
Yes.
Okay, cool. So I don't think I talked about this on your show before. So it's called the Augusta Rule. I'm sure some people have heard of it. Basically, in Augusta, Georgia, people were, the Masters golf tournaments in Augusta, Georgia. So people were, when the Masters would come to their hometown, they would like leave their house and rent it out because they know they can charge a bag for it, right? And then the IRS came and said, we're going to tax you on this money. And then because Augusta, Georgia, the people that live out there have so much money, they went to the government and basically they had a reform that said, okay, we won't tax you on the money as long as the rental days are 14 days or less.
Okay.
Right?
Okay.
So that means that if they can do it, we can do it too. So as a business owner, you can, if you own your home, you can rent out your primary residence to your business for 14 days a year.
Okay.
You can charge your business rental income for each day, and you don't have to pay taxes on the income that you receive.
Oh, wow.
So let's say you live in a good neighborhood, you do some rent comps. You say, hey, everybody around me, I can rent out my place for $1,000 a day. So you would do a lease agreement between you and your business, and you would say, all right, for these 14 days, I'm going to shoot content in my house because that's going to be the business use, and my business is going to cut me a check for $1,000 a day for 14 days. So you will cut your business will cut you a check for $14,000.
Yep.
Your business will get a $14,000 tax deduction for rent.
Yes.
And you will receive the $14,000 tax free.
Wow. Okay. So, okay. That makes sense. So my business is running for me and I don't have to pay tax on this $14,000. Got it. Okay.
Now, if you were smart, which you are, you would pick those days, those 14 days very strategically. What I mean by that is if you decide to rent out your home to your business when Beyonce's in town, or when the Lakers come in town, that rate might go from $1,000 a night to $2,000 a night.
That's true.
So now you're getting a $28,000 tax deduction, and you're getting $28,000 tax free.
Wow. Dang, this is good.
So we had somebody who lived in Arizona last year. He was a multimillionaire. He had like a crazy estate out there in Arizona, and he was normally able to charge $2,000 a night for his property. We decided to wait till the Super Bowl came in town. Mm-hmm. And the rent comps for 10 of the 14 days, you know, people come to Super Bowl early, went from $2,000 a night to about $3,800 a night.
Wow. So
he was able to host masterminds at his crib that whole week, 10 days, shoot some content, whatever. And we had about a $3,600 on average rental rate for those 14 days. So if we do 3,600 times 14, that is $50,000.
Tax-free money.
Tax-free money that he just got.
Right off for your business and income for me.
Mm-hmm.
Wow.
It's like little things like this, bro, that people just don't know, and it's costing them a fortune. Like ignorance is not bliss. Ignorance is expensive.
Let me ask this question too. I have like my in-laws come to stay with us for a little while, and they help out with the babies. Can I pay? Do I get a write-off for feeding them? We spend a lot of money on food. I love them. No, I love them because I mean, I would rather do that than hire a nanny. But I'm just saying, it'd be so much Instacart and DoorDash.
Yeah, didn't you say you looked at your expenses for food for the year and you was like,
it's nasty. It's disgusting. It's a disgusting number, bro. I got mad kids. It's mad people in my house, bro.
Yeah. Well, are you paying your kids from your business?
Every year I meant to do it. The $12,000, right?
No, it's actually $14,600. So you can pay.
Can I backlog that?
No, because you don't have you have the records.
I'm gonna just do it today. So
yeah, you can pay
every year I think about it.
Each of your kids up to $14,600 from your business.
Even my 1-year-old?
No, 1-year-old you can't do. I would say between the ages like 6 and 17.
What if they models though?
Yeah, but hey, so that you can do it if they're models, but does a model deserve $14,000?
Yeah. What? For the whole year? I got cute kids. My kid's real cute. You gotta see her first before you start passing judgment.
No, I'm saying we want to pay them reasonable comps. I think paying a 1-year-old $14,000 is a little outside of the realm of reasonable. But if you
hold on, and a 6-year-old getting $14,000, is it?
Well, I mean, like it depends what they do. I mean, so I wouldn't start paying your kids. I say 6 and 17 because most people don't have businesses where a model would make sense. You do. You have a podcast.
Yeah.
But if you run a construction company, fam, you can't just say your 2-year-old is a model for your business.
That's true.
So I think a 6-year-old can actually like shred paper, clean the office. Like they can actually do things in the business. So, but in your case, if you want it, you can pay each of your kids up to $14,600 a year. You would get a $14,600 tax deduction, and your kids will receive that money tax free.
Tax free. Okay.
And then you can take $7,000.
I mean to do it every year.
You can take $7,000 of the $14,000, put it in a custodial Roth IRA for them. So now that the money is growing tax free, so you got a tax deduction on the front end. You pass the tax saving. You pass the money to your kids tax free, and now you put it in an investment account for it to grow for them tax free. And I always tell this stat: if you do this from age 6 to 18, by the time they graduate high school, they'll have $170,000 of tax-free money waiting on them at the age of 18, which then if they want to go to college, use that money. Or if they want to start a business, now they have $180,000 of seed capital to start their actual business.
That's good.
Yeah.
That's good. When you get married, you going to do a prenup?
Yes. Absolutely.
Okay.
Yeah. We making the bag, protecting the bag, and keeping the bag.
Do you have any of your parents or anything on payroll?
I have my aunt on payroll. Yeah, she does some admin work for me, so I put her on payroll. And that's the thing. Like, if you're gonna like pay, like if you're the breadwinner for your family, don't just give them money. Like, give them a job, pay them from the business, and you can get a tax deduction from the money that you're giving them instead of just giving it to them. Like, you can pay them for work that they actually do.
Got it.
And then you can get the tax deduction. I'm not giving people money. I'm giving them a job and I'm paying them from my business the right way.
You should sponsor the Social Proof podcast because it'll be a tax. Let me hear me out. You give me a bunch of money, but you get to write off the bunch of money.
The marketing budget is there. So
and then the marketing budget. Okay, I think we'll probably outperform ads.
All right. I mean, we can talk about
how
it.
much you want? How much per month? Just give me like a monthly number, and I'll see what we could do.
10,000 a month.
10,000 a month.
What would that get?
I don't know. Let's talk about it. What do you want? What you thinking? What would you like me to do?
I have so it's tax season and I have a big event that's coming up where I'm going to teach entrepreneurs how to save about $50,000 in a couple days. So I think that we can find something to do around that.
You could be a sponsor. Okay, you'll be a sponsor, and maybe every episode there's like a little Carter segment or tax segment in there.
Okay.
And you're teaching something. It's like maybe like a 5-minute something in there.
Okay.
And then you'll be the official tax sponsor of the Social Proof podcast.
Let's make it happen. See, business gets done on the show. Let's make it happen. It's tax season, man. We got to help the people. We got people paying a lot of money to the IRS, man. I tell them, like, I agree that everybody should pay taxes, but like, let's not leave a tip, bro.
Yeah.
You know, people tipping the IRS, but they ain't tip you when you was at the Cheesecake Factory, bro.
That's a fact.
You know?
And I just want to say the only reason I suggested that is because I want you to save money in taxes, okay? I'm thinking about you. I got you in mind while I'm suggesting that, okay? Because I know you want to. You make too much money, Carter.
No, bro. You got it, bro. You got it, man. It's about making it and keeping it, man. And that's what I'm here to help the people do.
Yes, absolutely. All right. So, dating rich. How's that?
It's interesting.
Dates be going crazy.
It's interesting because you have to find a balance of showing somebody something, but not showing them a whole lot. So it's tough.
I mean, but you want to show them enough to
yeah, you want to show them enough because like the level of women that I'm dating at this level, like they only dating guys that have something.
How does it make you feel?
How does it make you feel? That?
Yeah, like the women that you're dating want to date someone who has it, which is right. It's right.
Nobody wants to like date somebody they're gonna be struggling with, right?
Yeah,
like,
for sure. But do you ever get a sense like, man, they're dating me because I got this?
It's interesting because I've always had confidence. So even if I was broke, I'm still shooting for the same girls. You know what I'm saying? But
there's another.
I mean, no, I'm shooting, but like that means I'll go in. I've always been a shooter, but that don't mean I'll go in, bro. Right. But I'm a shoot. But I think that there's a way how to go about it, right? I think there's the most, I won't say ugly, but one of the things I just dislike the most is expectation. Because I got it don't mean it's yours. Because I got it don't mean I got to spend it on you. I understand you want a man that has it because you want somebody who can secure you financially, emotionally, physically. You want to feel protected as a woman, and I respect that, and I encourage you to chase that. But that doesn't mean that person's money is yours for you to start expecting that they should be giving you a certain amount of money for something. You know what I'm saying?
I understand that.
Like I know
the fact that they're dating people who have it, there has to be an expectation that some of that is coming my way.
Expectations are the quickest way to get you cut off. Like I advise women to trade their expectation for appreciation. Just appreciate the fact that I can do something for you. That doesn't mean I have to do something for you.
I see that.
You know?
I feel that.
Yeah. So
I feel that.
Yeah, but it's interesting.
But do you go crazy on dates though? Like a lot of Italy trips and all that? Or?
Not on a date, but I will fly somebody out though. Yeah.
Every time you go somewhere?
If I want somebody who's not in my city, I'll fly them out. Yeah.
What you mean?
Like if I want, like if you're not where I'm at, like if you live somewhere else, I'll just fly you to come see me and treat it like a regular date, and then fly you back home.
You be doing that?
Yeah. Not all the time, but for the right person.
Turnarounds?
No, not the same day, but like a weekend. Like, yeah.
Okay.
Yeah.
All right, let me ask this.
Here we go. This is, I mean, I'm here for it, Shan. So I'm here for it because we always somehow end up here.
So here's, because I mean, you're an easy target, bro. Because you're single, attractive brother.
Thank you.
You know what I mean? You got money, and people know you have money because you talk about money. Like, obviously, you're not going to be broke helping others.
It would be irrational, yeah.
So, are there cases where you have some sort of associate that you connect with in the DMs or something like that, and you're leading with, all right, well, fly out. Day one, like, fly out.
I probably won't come out that strong, and honestly, like, if you come in my DMs, you're probably gonna get sold something. But but if you come in the DMs, if I come in the DMs, I mean,
somebody LOL something, you like, you crazy, you started, and be like, yo, what you got going on?
Yeah.
Like,
Marty had this tweet he made at the beginning of the year. It was like 2023 goes, not date one of my followers, and then like day one of 2024 he got exited out. It was like 2025 goes. So I'll do that. But like, so here's where I'm at, bro. And
you go crazy.
No, here's where I'm at. I am at a place where I am comfortable doing what I want, and I am very honest with a woman up front. And I think that I don't like when guys like lead a woman on, or like try to like use their money to give them a lifestyle that they can't afford and then take it away from them to try to like, I don't like that. I'm very upfront with what I want. If I want you, I'm gonna fly you out. You come see me, and then we'll.
Hold on real quick. When you say upfront, how upfront?
I'm upfront with my intentions. If I like you, I'll let you know. If I'm just like trying to have some fun, I'll also let you know, because I believe in letting.
How do you say that though? Listen, I wasn't like super up when I was single, so I'm trying to understand how this thing works. So when you say intention, because there's this argument online where it's like, just because man fly me out don't mean I gotta do this and that. You're upfront. Is it, hey, I want to fly you out. I just want to be on the same page.
Yeah, like I mean,
expectation.
I'm not gonna say just because somebody flies you out, you have an expectation to have sex with that person. Correct. But if you're flying out, if somebody's about to fly you out, you say, well, I'm flying out, but I'm not having sex with you. You probably won't get, like, if you come like that, you probably won't get flown out that day. Like, you know what I'm saying? Like, that's just on you. You know what I'm saying? Right. But yeah.
How do you have that conversation though? Like, I know we just talking, I'm flying you out. However,
well,
do you say
I will wait to see if I like a girl before I fly her out, because if I don't like you and I fly you out and like you don't, it just doesn't, it's not a good mix, or we don't end up taking it that far. I never want to fly a girl out and just because she doesn't have sex to get an attitude. I think that's childish.
No, that's what I'm saying. Are you upfront with, okay, I like you in the DM.
Yeah.
Yo, won't you come spend the weekend? Or I got this mastermind in Puerto Rico or something. I want to bring you with me.
Yeah.
On top of that conversation, is there a way that you're sliding in this expectation so that we're on the same page? Yeah,
but if I like you, I'm okay with is like not having to have sex with you the first time we kick it.
I see. Okay, you know I was going off of you saying like, yo, I'm very upfront with my intentions.
Yeah, but if I don't, and it's just what it is, then I'm gonna let you know, like off the strength, like you. Because if a girl comes at me like, yo, like, I want to know what's to it. Like, it's all right, come on, let me show you. Like, but like, if you come to me like that, don't fold when you get here. Like, you started out swinging, so keep that same energy.
Do they start out swinging like that?
Some girls start out swinging like that. Some girls
like, I want to know what's happening. Like,
some girls is crazy, bro. Yeah, they're crazy. You were right to not date when you were. You did it right. You did it right.
Never got married. You know what I mean? Like, thank God.
God knew, man. God
for sure.
God knew.
So they just come out swinging, and you let them
everybody.
Hit you, don't you?
Not
you let them hit you.
Not everybody, bro. Not everybody. Not everybody. Chill out, bro. Chill out. Here we go. Like, every time. And like, it's like every time though. Like every time we somehow get here.
A well-rounded conversation, Carter. Okay.
I'll never forget what happened on that couch. I never forget what happened on that couch.
Yo, because it was such a surprise, bro. Like I didn't.
Your eyes were like a kid, and a kid is still like when I knew you knew. You was like, oh, and then you just.
And I gotta press.
He grabbed the shovel and he's like, yeah, bro, we gonna be here for a while, dog.
Oh my God. gosh.
But yeah, man.
Are you actually dating like for marriage now at some point or no? Or are you just chilling right now?
So I'm dating this chick in Medellin, and
really,
yeah, she's cool, and she's okay with like not having a monogamous relationship.
Oh, so she outside.
Well, no, she's okay with me not being monogamous to her.
Are you okay with her not being monogamous to you?
She doesn't want to not be monogamous to me. That's her choice, though. So, yeah, I personally don't submit to monogamy right now.
You don't submit. That was an interesting word choice.
Yeah.
You don't submit to monogamy.
Yeah, I mean, I feel like, and again, maybe this changes in the future, but like, I don't think that for me, at least being one person for the rest of my life, like just only one person is like reasonable.
You don't ever see that.
I do maybe one day, but it's not right now.
Not right now.
Yeah. And I'll try to be extremely upfront with the people I talk to.
So would you marry? And again, this isn't listen, y'all, if you're listening, this is not a relationship conversation, but I'm trying to give some insight on how a rich entrepreneur handles the other side of their life. Because I think that's important to know.
Yeah. I think it's.
And Carter, if you was, here's what's interesting. Let me ask the question. Mm-hmm. Try to at some point imagine yourself being the manager at Target. Okay. Let's say you're just like regular Carter.
I was regular at one point. Yeah.
You'll probably feel differently about monogamy.
Probably. But like when you don't settle for an ordinary life in one area of your life, it can lead to not settling for ordinary in other areas of your life. And I think the problem with most guys, bro, is they try to live extraordinary on one side, but then ordinary on the other side. Yeah. Like you want to be an ordinary dude and not put in the work and work at Target. And if you work at Target, that's cool. But like, then don't try to be like, oh, I don't want to be monogamous. You haven't afforded that right, bro. Like, you know what I'm saying? Like you can't like not, you can't not take care of business at one area of your life then want to be extraordinary in other aspects of your life. But I feel like if you do extraordinary things on one side, it can tailor on to you doing things on other sides. So that's my take. Again, don't take relationship advice from me.
No. Yeah, it's not a relationship advice. It's just like your story and your perspective. So that's why I really like that. So essentially, your success in this area is going to prevent you from having a monogamous relationship. Or makes it even harder to get married.
When I talk to it's interesting. When I talk to my therapist about it, because I have a therapist now, probably one of the best investments I made in recent memory. The reason I avoided relationships so much in my life, I've only been like 5, like 4 or 5 relationships in my entire life. And it's because when I view relationships as like boring, like it's like when I with somebody, I looked at it as if like I'm sacrificing something. Yeah. And she said something very interesting to me. She was like, well, why do you think that all relationships are gonna be boring? And I was like, well, like that's just my view. I think that like it's a sacrifice. She was like, well, if you do extraordinary things in your personal life, you travel, you've been to 35 countries, if you do extraordinary things in your business, why couldn't your relationships be just as extraordinary as other parts of your life? And I started thinking like, well, like maybe I get to set the rules of how I want to be in a relationship. Maybe I can set the rules on relationship not feeling like a sacrifice. And if it doesn't feel like a sacrifice to me, maybe it's something I can stay in for the long term. So that's why I've been more open and just exploring things that I want to see that maybe there's one day or one framework of relationships that can make me feel like it's not a boring sacrifice, something for me to do.
Got it. Okay. You handled these questions really well.
Getting better, brother.
Yeah,
we had some bad moments, so we gotta have some good ones to equal it out.
Absolutely. Yeah. So that is, we don't have time to get into it like that, but that's a very, very interesting conversation, man. Like people's view on relationship could be influenced heavily by their financial status, especially a man. You're young, healthy. You know what I mean? You can have your choice, and it's like, why would I want to give up the right to have my choice?
Yeah.
Right.
And I heard, dude, this is what really was crazy to me. But I heard somebody, who was it, Andrew Tate, I think, said it. He's who he is. But he had a really interesting.
Who's Andrew Tate? I heard that name before. What does he do?
Yeah.
Or
he speaks
like
to
Kevin Samuels kind of?
not
Like Finesser?
Finesser
Don't talk bad though.
No, he
he talks more to men. Actually,
yeah, and I don't think this was a bad view. It was an interesting view. He said like, so women, when they date a guy, they want a guy to be monogamous with them. Most women, and then he was like, well, here's an interesting thing. When a woman was in her prime, when most women were in their prime, which is like 19, 20, 21, they wouldn't think about monogamy. Mm-hmm. They was in the club, on boats, on yachts, in Miami spring break, kicking it. When they were in their prime season, they weren't thinking about monogamy. They were
I don't agree.
You don't agree?
I don't agree.
You don't think so?
No. There's always going to be some little thotty bodies out here.
Yeah, well, I mean,
but there's always that one girl that's on the girl's trip that's on the phone with their boyfriend the whole time.
Yeah,
Still having fun,
and this is not for this is not the mass market. I'm just saying, but when a lot of women are in college, 19, 20, 21, they're having fun.
Nah, I don't agree.
Really?
No.
Okay.
No.
Okay.
I think even back then, my entire experience with women, for the most part, this isn't everybody, but for the most part, are looking for that safe, secure thing, whether it's with the popular guy, whether it's with the star football player, whether it's everybody. Not everybody, but there's a lot of women that were looking for that something special. Now, if they don't find something special, then they're outside. It is what it is. And I'm out here with my girls because I don't have someone that I'm committed to. And a lot of times it's the man not wanting the commitment. So I don't know if I agree with that.
Okay, cool.
Finish your statement though. I'm sorry, I cut you off.
Well, no, I mean if you don't agree, we don't have to.
But there's no fact to it, right? It's just opinion.
But like, so his point was when a lot of women were 19, 20, 21 in their prime, they were having fun. I mean, they're young, they should, whatever. Yeah. They weren't thinking about monogamy. But when a guy, just because a woman hit their prime at 19, 20, 21, that's not a guy's prime. A guy's prime is when he's like late 20s, early 30s, sometimes 40s, when he has his business together, his body together, his mental clarity together. And most guys, that prime season might be 34, 35. Mm. So when a guy's hitting his prime, like
that's true.
you want us to settle down when we hitting our prime. But when you were in your prime, you was on boats at spring break and yachts. But now that they get flued out. But now that you passed your prime, 25, 26, 27, and I'm hitting my prime at 35, 36, now you want me to slow down. But I work for this prime. You know what I'm saying? So I think that it's just a different, and it's not a right or wrong, it's just a different dynamic.
That's good. That's a good conversation.
Yeah.
You know what? Yo, here's what's crazy, bro. I want to start a relationship podcast so bad.
The questions you come up with them, yeah.
But I don't know. Maybe I'll talk to my wife about it. She's not gonna want me to do that though.
Yeah, I'm about to say she's
not gonna be feeling
dangerous.
Because I'd have to go too many like wild directions, and I know me. I'm gonna go down a rabbit hole, and we gonna get there. And then it might just ruin my brand. Like, hey, why you on that? So I'm gonna stick to entrepreneurship, guys. Listen, Carter, thanks for coming through, man. Oh, you got something. That you wanted to share because I don't forget money, but you said it was something. You said something I can be a part of.
Yeah, it's something I do once a year. I do a tax-free living challenge every year. They spend 5 days with me, and I go over the top 5 tax strategies each day that's going to guarantee help you save $50,000 in taxes. So taxfreechallenge.com, and you can grab a ticket, and I do it once a year. It's that season, so I want to be during tax time, I want to give the people the strategies that they need to succeed.
How am I going to take part in that again, Carter? I'm thinking about me right now.
Okay. I'm a
promo code? Or no, not really.
Yeah.
You'll be the official sponsor.
Yeah. We'll work the sponsor out, bro.
Yeah, we'll work that out.
All right.
Hey, look, I try to be upfront with my audience. Yeah. Hey, listen.
Yeah.
I need to be a part of this, but y'all, for one, I am going to have a conversation with you after this, so you can look at my tax situation because I don't want to. It's just it's a lot of money going out, bro. It's a lot of money, and I feel like, and I haven't found a tax organization that I feel comfortable with yet.
Okay.
That can handle my situation because I got a lot of complexities.
You got a lot of businesses, bro.
It's crazy.
And you got partnerships and stuff.
Yeah, so I have partnerships that I do business with, right? But then I have another company. I have another company where I do syndicate real estate deals with. Then I have another company where it's like me and Donnie have a partnership in the stuff that we do over here. And then if I buy real estate by myself, that's another company. And it's like, it's all kind of stuff going on, man. So yeah, I'm confused.
Let me go figure it out.
All right, the responsibility of making money. So listen, go to, what's the website?
Taxfreechallenge.com.
Go to taxfreechallenge.com. Hit Carter in the DM, might get flued out. You never know. How should they approach you?
What, women? I mean, how they approach. Every woman has a different approach, so it just surprised me.
Do they ever like just send a picture, like a wild picture, like, yo, is that coming out swinging?
Chill out, man. We can end it right there. We can end it right there.
All right, what's your Skymiles number?
Lord have mercy on me.
Oh, man, I hope that girl in the Medellin ain't listening to this.
No, she cool. She know everything, though.
She don't be watching the podcast and stuff?
She can't speak English, so. She speaks Spanish.
She can't speak English?
No.
You speak Spanish?
Yeah.
Fluently?
Fluently.
Really? How'd you do that?
Dating a girl that only speaks Spanish.
Are you serious?
No, but I minored in college, but then I got really good when we started dating.
You speak Spanish fluently?
Sí, yo hablo Spanish. Yo hablo español muy bien. Yo estudié para 5 años en el pasado, pero ahora yo vivo en Medellín, entonces yo puedo practicar todos los días.
And you learn primarily by dating a Spanish woman?
Yes.
How long did it take to get fluent? I mean, you had the foundation in school.
Yeah,
right?
the foundation. Probably like the first 4 to 6 months. It got really good. And then after that, it just snowballed. Yeah. So I have a house.
Oh my gosh, I got mad questions. How the heck you go from I don't speak English, she only speaks Spanish, y'all get together. It's like a love language. It was love language.
Yeah, and then, like, when you want something bad enough, your brain figures it out really quickly. So.
Must be
bad. Probably not. We'll see.
Yo, you know one of my favorite songs, and this is by Usher. It's literally one of my favorite songs. It's called.
It's new?
Huh?
It's not okay. No.
No. But if you never heard it, it's called "How Do I Say." You ever heard that song?
No. How do I say?
Yo, what? That song, you're gonna fall in love with that song.
How do I say?
How do I say? I think that's the name of the song, right, Reese?
Yeah.
So pretty much the whole song is about him dating someone that doesn't speak his language, and he's like, "Yo, how do I say I love you? How do I say I need you? How do I say?
Wow.
How do I? Yo, that song is. You're gonna fall. We're gonna.
I'm searching for it right now.
Yeah, listen, I will play it. I'll let you listen to it. I don't want to play it for you. That's weird. But I'll let you listen to it. It's literally one of my favorite songs. I remember playing it for my wife, and I played it for her a couple times, and it's just a beautiful song. But I think you'll really resonate with it. I think it's called "How Do I Say" by Usher. It is Usher, right? Mm-hmm. Let me see. How do I say? Yeah, How Do I Say by Usher. It's on Confessions.
Okay, I found it.
8701. All right, y'all, man. Make sure y'all rock with Carter. Oh, take us out with a word of wisdom, man. Give us something to think about.
A word of wisdom. Okay. If you want to, this is about money. So if you want to have an above average income, you must first become an above average person. Most people aren't willing to do the extraordinary things to become extraordinary. So everybody wants the outputs, but they don't want to put in the inputs. So
that's good.
Yeah.
All right. Now it's time to put in the work, y'all. Listen, if you are struggling in this area, I'm telling you need to hit them up right now because taxes are absolutely no joke, okay? It's all cool to make the money. It's all well and good until the end of the year, you have a burden on your back, okay? And it's really, really serious. So make sure y'all hit up Carter Cofield and do yourself a favor. Get you some social proof, meaning go build something and build it really, really big. But it is your responsibility, your duty to come back to your community and teach them how you did it. It's the only way our community grows, all right? We are out of here. Peace. That was good. If you like the video that you just watched, click this one. You're going to like this one, maybe even more. Click it right now.